All right, welcome back to another episode of Exploring the Process. This is episode 13. I know last week we mentioned that Rivet would try to be back on, but he had some scheduling issues this week. So you got Chris and I. We're back, the fantastic duo here. But we do have some guests lined up, so really excited. We've got probably 3 to 4 weeks worth of guests lined up, Chris? So it's just kind of a matter of getting some schedules together and stuff like that. But things, so we'll kind of get back to having some other folks join and share their process and things that are important to them. One in particular, we've got kind of an Air Force pilot that's going to be a retired Air Force pilot that's going to be coming on, which should be pretty cool. And then another a woman who's been in the industry since 97, I think she said. So that's going to be really fun, kind of some nice diversification here over the next couple of weeks. So look out for those. But this week, Chris, you and I were talking about getting last night on the notebook review. And that's available if you haven't watched it yet. I pinned it to my profile. It was a really good session. I think we did kept it really kind of back to the core. I guess probably a little inspired by Keith last week, kind of, keeping it to the notebook, trying to stay on point, but also coaching a little bit too, right? I mean, I don't really, I don't think I'm certainly not as good of a coach as Keith, but those questions do arise, right? And one of those questions and kind of the conversation spearheaded around especially XLU, but I mean, I'll take it more granular. And if we take a step back, it's more about timing and position sizing, right? So sizing and timing in terms of when, where to have, what securities to have at your mid max, when, it's basically the question when we all work really hard to try to get right. And that's the name of the game. And if you can get that timing and sizing right, it really helps. I love your analogy. It helps knock down the dominos. So it's easier to either be more patient on the next trade or to kind of just be able to ride that winner for longer because you're sized appropriately. Gavin mentioned on XLU that he had taken it to max and now back down to min after this run. I haven't played. I now have, because I've been trimming it, I now have like a 50 to 75 basis point position in XLU, but I had only gotten it to 2%. It just never came back. It never came back to where I felt comfortable, getting, basically buying more. So that was me. I didn't really do the Momo trade, and sometimes I've been good with that. I just didn't catch it, but it's not about like me or really you. It's about kind of the setup, right? In terms of where, but I think the other thing too is we have that go anywhere strategy. So just if like XLU is run, and this was one of the things that you and I try to get across consistently, there's always something that you can buy or sell at the low end of the range or the top end of the range.
Yeah. I think it's, I was thinking about it this morning when I was walking the dog, that especially the factors, like the factor ETFs, like they all kind of trade together. It's like all the factor shops are kind of all just doing the same thing. And it's strange. It's strange that the factors seem to be more correlated. And I haven't quantified this. It feels like the factors are more correlated than the sectors are sometimes. That's just visually, so it's just take that as it will. But
no, definitely no. I mean, Chris,
it's one of those things, especially talking, obviously to a lot of guys from the US. It's all equities based. Even if they want to take a copper play, it's like, oh, what copper miner should I buy? Like, why don't you just buy copper? And it's like, and not the ETF. Like, have you got access to a futures account or whatever? Because there's all kinds of things that are tied into the construction of the ETF that doesn't necessarily mean it reflects the spot price. So
correct.
I kind of joked when the question came up, and I was serious. I hope it wasn't like it was a joke. But I am serious. The fact that we spent like 20 minutes talking about XLU never going to the low end of the range means that that's what it's going to do.
I know.
I'm not trying to like dismiss the question, but that's what it is going to do. And what it will do is it will pull back. Everyone will think this is my one time to get in. it will have a little bounce and it will pull back further, and the risk range will expand, and everyone will be like, oh, well, the low end of the range just doesn't work anymore. And that's what it will do. So,
I mean, you're spot on, and it was one of the reasons why I retweet. I loved your tweet last night. It was like it was just perfect, right? In terms of XLU is now almost guaranteed to go to low end of the range, and it's going to go lower than what the low end of it's going to go lower, and it's going to likely retest, like certainly trade and possibly trend.
Yeah,
and that's and I think gold is a good example. You brought this up yesterday as well on the call, on the session. And gold to me is a perfect example of that. Like if you go back a month ago, it had a very similar absolute ramp higher, right? It pulled back. Some folks couldn't wait, they gave it 2 days or 3 days, and then they started getting in, and then they're like, well, shit, like it's now 3% lower or 4%, whatever it is, of where I sized back up or got really aggressively big,
where everyone thought this is my one chance.
Correct. And I think and that's where I think patience comes in. And then obviously learning, right? The more quads and the more, the more kind of like experience you have with these individual takers, or kind of, the inventory. I love that from Keith. Like, as you get more comfortable with the various inventory at your disposal, you'll understand, like you get a better feel for one, how they trade, and two, like what the levels become, right? In terms of like of giving you better timing and that kind of thing. So for me, the way that I've kind of helped this process, and I mentioned this last week about setting limit orders, right? So I'll look at the low end of the risk ranges, stuff like that, and I'll kind of, again, just, it's not arbitrary. I have a system, but like I'll set kind of limit orders below kind of the risk range that I'll get. So like for gold, I don't know, I don't have it. Haven't gotten it yet this morning, but 1910 was yesterday's low, right? So maybe I'd kind of take a spot on GLD in terms of the US equity, where, in this case, I think it's around like 177, right? So I think I have a limit order in at like 176, like 92 or something, right? So it's like, because we're now, and to me, that's a little bit, not even aggressive, because it's kind of traded below that. But at this time and space, in my humble opinion, and I think you agree with me, Chris, is that gold has consolidated a lot over the last month. And I texted you this morning, like we don't love to use the word feels, but it certainly feels like a coiled spring at this point, given what we see on the horizon, that it's going to like explode, right? And again, this is not investment advice. It's just sort of what I've seen over time, over the last few years of doing this. And so right now, I think being a bit more aggressive is not even the right word, but being a little less cheeky with like where you're getting in. And again, just for full disclosure, I've got like anywhere between 10 and 11% exposure. So I only need like another basically 100 to 150 bips to get to my max position. So I can be, I'm currently in a place where I can, because, I don't mind paying up a little bit, because like one, I think the timing is on my side, right? Like I think the timing is on my side, and I want to make sure that I'm at max position, right? So I don't know what you're seeing or how you've gone about it.
I think the perfect example, right, is the questions kept coming up about XLU. They weren't a month ago.
Yeah, exactly. Well, and
these questions were coming up, 3 or 4 weeks ago about gold, and now nobody's talking about gold.
Right. And that was kind of my point.
Like I keep in like a couple of chats that we've got, I keep sort of saying, it feels like I'm going against Keith, because my signal's getting close to saying I should be short gold, whereas Keith's only just added it back onto the risk ranges as bullish trend. So I'm like, I've got that bit in my head, because the last time I faded myself was with oil when Keith got out, when my system was telling me to get max long. So I'm like 50-50. I'm like, what do I do? But yeah, going back, like, nobody was talking about XLU a month ago because it was going down on its way from 71 to 65.
Yeah.
At which point that was where nobody wanted it, but it's easy to say it now, but that's when it was probably at the low end of the range, and it felt like crap, and that was the best time you wanted to buy it.
Correct. Yeah, and even after that run where it went from like 65 to 70, right? It was like 61. I mean, that's what I was trying to get at. That's when it got added. It got added to it got added to risk ranges on, I believe it was March 11th, I think is what I said yesterday, something like that. Hold on.
Yeah, so this just from a timing, right? So it had gone on the run. So 24th of Feb. Yeah,
so March 11th, it was added to the risk ranges.
Let me
so if you pull up it's that really big green button.
The big green button. I've got it. Yeah. So can you see that now? Yeah.
Yeah. So March 11th, it was added to risk ranges.
Okay. So we had the big dip, 24th of Feb. It went on this big run.
Yep. That was the 8th.
Basically, yeah. So
basically got
11th was on this dip. It got added back onto risk ranges, right?
Yeah, it was added on the 11th, and then it basically traded sideways there. But again, I mean, because of the move, just the way the math works, I mean, the low end of the risk range was still down at like 66 for like, especially on day one, right? On day one, it was 66.70 to 72.71, right? Mm-hmm. So 66, it was actually $1 lower than that. It was 66.70. Anyway, so I mean, there's a lot of downside there, right? Just from a math perspective. Yeah, it was all the way down there, right? So that's anyway, so that's kind of, if you didn't, like, we talked about it, I remember on that last week of March, I believe it was, on the notebook review. I think it was just before that, those last 3 days of like moving higher, right? So it was kind of in that little consolidation phase, but again, it had just popped, and it was just like, oh, this is interesting, but nothing, wasn't one where it's like, let's get max position. But my point is that, what I said yesterday is that low end of the risk range moves significantly higher. So like from 66.70 to, March 17th, it's at 68.77. So it moved like $2 in a matter of like, 6 days or a week. And that's the whole thing, right? Like when you see that kind of a move and putting in higher lows, and your top end either staying strong or moving higher, that's when the signal is just getting better, right? And that's all I was trying to get at last night, is like, you got to be paying attention to those kind of things. And then to the flip side of that, you've got something like energy, which just put in a big lower high yesterday. Yeah. And there's a question on Twitter about like, what do you consider kind of a lower high or a big lower high? And Chris, I don't know if you have a thought, but
I don't know. It's really hard. I would always get caught up in the kind of like, what does Keith mean? Like what?
Yeah.
It either is or it isn't.
Yeah.
Is the number lower or not? That's it. That's for me.
I would agree. And for me, it's like the amount, right? Like, especially in XLE is a good example, where on Monday, the high was 78.88. So almost right at the top of that box, 78.88. Yeah. And yesterday, it's 78.55. So again, it's like, that to me is just like a bit of a lower high, because this could be consolidating, right? Like, but the thing is though, is that it's putting in a lower low. So it's like, it's now 74.24 on the low side. So again, that's likely not, it's not, it could be testing trade maybe, but it's not going to be testing trend or anything like that. Like, it still is absolutely bullish. It's just, it's kind of given a bit of a pause here. So I think, again, like many things in life, it's either going to go higher or it's going to go lower. but given the outlook, I would think, and the call on disinflation, that those kind of putting a couple of those other pieces of the puzzle together, that's where I would say, it's likely time to kind of take your chips off the table here and go find something else. So we had a bit of, apologies there. We had a bit of a technical issue. Chris is computer, what have you, kind of froze up. So he got booted out. So, we were in the middle of talking about energy and just sort of, again, given the outlook of disinflation and what have you, with the signal that it's giving, that's where I would kind of just, if I've been long, I'd be taking my chips off the table. And I did that last week. So that's just me. But again, this is where I think, you're looking at not just one thing. So it's not just the risk range. It's, it's the whole picture, and that kind of thing. So I don't know if you want to flip to gold at all, or if you want to keep talking about.
Yeah. So let me just try and bring up a non-messy chart. Okay, it's pretty messy. Okay. Just on the big lower highs and higher lows and all that sort of thing. Since I've been using these boxes that with that we talked about a few weeks ago, the only thing I can think, whether it's big or whether it's just low or high, is when something like, so this red box is the 1 month. So obviously this price falling out of the look back, would have been big. So it was like a $50, $54 shift.
Yep. And it's soon going to go down to, it's soon going to go drop another $40 to 1960.
So yeah, out of tomorrow, yeah, it's going to come down to, yeah. So this is what we were saying, and Keith talks about it. This is where the range is just compressing and just keeps getting smaller. And all it means to me is it can mean one of two things. It means one, it's getting closer to the low end of the range, so it can potentially cascade. But just as much as that, it's also more likely to move into the top of the range, because I always split my ranges in half. It's more likely, it's also closer to moving into the top half of the range, where it's going to pick up momentum and move forward.
Yeah. So somebody asked last night about that, about kind of how do you think about different, within the range? So you split it in half. Is there any back test there?
So
or you just kind of.
So the only one I've done it for the S&P 500, because so I don't have spreadsheets with all the past ranges in them. So I asked on the arena, and a few people put in the ranges that they had. So I think I had like a 24-month, maybe a 2.5 year back test.
Mm-hmm.
And so if you split the range in half, let's say it's going from 2000 to 1000, the center line would be 1500. And I just really simply looked at the daily returns and just said, right, if the price closes above that center line all the way through the 2 years, if it closes above it, what's the average return? So from memory, I can't remember, it was like plus 0.8%, but okay, the percentage positive was higher as well. It was like 80%. So if it closes in the top half, it's more likely to go up.
To keep going up. Got it.
Yeah, but the return gets smaller. That implies lower volatility, right?
Yeah.
And then if it closes below, so it closes in the bottom half, the expected return falls down. It does turn negative off the top of my head. I think it's minus 1.5. And it's more likely to be negative.
Gotcha. So in this example, that's where, having time help compress basically the 1 month high, narrows the range, which means it doesn't take much of a move to get it up to the top half of the risk range, which then, to your point, typically begets continued moves higher.
Yeah. So obviously this isn't the risk range. This is just this is just my representation of basically momentum, really.
Yes, of course.
Okay. So this red box here, we'll move down to the same place we are at the blue box, and all of these kind of center lines we'll come here. So 1938. So like I said, so this has acted like support, which is just this center line of the box. So obviously as the price went up, the middle of the box also went up, and this has acted like support perfectly here, right?
Yep.
So like in terms of that, now that this big move has fallen out, which I think is what will be happening in XLU. Okay. So this was to use the XLU example, we got a pullback. It was a pretty steep pullback, but everyone thought this was the only chance I was going to get back in again. And then it cascades again because as this move was happening, all these shorter time frame levels are all moving closer and closer. So it's the reverse now, but the price is closer to these levels to potentially break momentum.
Correct.
Whereas now here, so this red line, this red center line is going to come here to exactly the same place as the green and the blue, which means you're in this tight box of either cascading down potentially, or it only needs to reach 1938 and close above that to have momentum across different time frames.
Multiple time frames. Yep.
Yeah. So if somebody has some kind of 10-day momentum signal, it will get picked up potentially.
Yep.
And this is where like all the trades, like any one trade, any one move is captured by all kinds of different. Okay. So the 10-day momentum might be picked up by high frequency traders, whatever. But then if the move continues, it then shifts into, I think this big move in gold, whatever kicked it off, the war and Russia and whatever kicked it off, that last big part was a lot of out of the money calls going in the money, which meant they had to buy underlying to cover the puts, to cover the calls, right?
Yep.
So this is where it's never one thing. So it's never one thing. This is kind of technical. Now it's my way of kind of thinking like a computer rather than technical analysis.
Yep.
And
I think that's a really good point, right? It's like, okay, how do you simplify it to think like a computer? Because they are one of the bigger drivers of the market.
Exactly. So, and that's kind of my thing. So from the 1970s and whatever, that technical analysis worked. Yeah, because the kind of marginal person buying stocks was probably using it. So that's why it had a big impact. But anyway, so so just in terms of that, it's going to move from like a 5 or 10-day momentum trade, and it's going to get, it's going to get picked up by somebody, a trend follower that uses like a 30-day breakout or something. It's not just going to be one thing. The entire trade, the entire move, whether up or down, will be picked up by different components as it's moving along.
Yep.
And that's where I'm not a value investor, but I listen to a value podcast just so that I know how in general they kind of think about these prices and whether I am still a trend follower, but I listen to a trend following podcast, and part of that is on a Monday episode or whatever, they give like the past week or the past month's performance, and they say like, oh, we're max long oil and this and that and whatever, and we're max short bonds, and you just get a feeling of where they are, just like using CFTC positions.
Yep.
So it just gives you an idea of like, right, I'm long gold, and all these guys, like everyone's long gold. People on the macro show are saying we've never had a chance to get back into gold since it's gone bullish, so you can kind of get even if it's like that, even if that horrible word, even if it is a feeling like everyone's banging on about it now and it's not talking about going to the low end of the range, I should take some off the table.
Yes.
But so like now, I'm max long gold now. I've been using all this to get back in, right?
Yeah. And I have as well, right? Like I went to, I think 6 or maybe even 5% on that pop up. I think we both traded it really, really well earlier, like a month ago. Yeah. And then also well in terms of being patient. Like I kind of put my first entry probably at the beginning of the month there, kind of on that, a couple of those lower dips, right? And then sort of didn't really chase it. Anyway, I think you and I have both I guess I've played gold pretty well in the last 2 months, which is great because it's one of our largest assets, potentially our max position of like 12%, right? So it's
exactly, and that's the point. If it moves, if I'm at my max position now, if it moves, I will automatically be above my max position.
Exactly.
Right. So I'll have to take some off the table. It'll move, but it might even move just into the top of the risk range. And I'll already have to be starting to reduce my position size.
Yep.
Which is completely different. This is the domino part. Once you get the first couple of trades right, it then cascades because you can take some off of this one and buy this one that nobody's talking about. But it's hard if you don't get, if you get completely out of sync, you're just chasing your tail constantly. You've not got enough in this, so you can't sell some to buy this other one. And you just get in a big spiral because you just end up making bad decisions because it's like, oh, well, I haven't made enough in this, so I'm just going to let it run. And yeah. So you just end up just chasing your tail, and you just on the back foot instead of being on the front foot.
Yeah. And certainly something that I've worked on is definitely having a bit of that, call it wiggle room, right? In terms of like, maybe, if I don't get it fully to max, certainly have it at that mid or between mid and max type range, so that, if you are right, you have some room to basically trim it down and still, we've talked about this before, kind of that mid position is about letting the momentum ride, right? And like basically being that trend follower and having at least a portion of your capital allocated to something that's working, right? Like, Keith always mentions sort of, let winners win, right? Or let them ride and follow that winning trade. And so, I think that's
the hardest. That's the hardest bit. The hardest part. Like we've said about XLU, everyone's saying it's not going to get to the low end of the range, and nobody's asking questions about gold at the minute. Although Keith did have it on the top 3 things, so he's highlighting it.
Yeah, yesterday he specifically said dollar is number 1 asset allocation, gold is number 2. Like he can't be any clearer than that. So again, like if you're not using this to gross up your max position in gold, then you're really just not executing on the process appropriately.
Exactly. And then, so that's it. So this will put, so even if it has a big move, let's say it goes, whatever, say it has a $50-$60 move, you have the choice to then reduce your position.
Yep.
One, it's going to come up against, if you've managed to fill your allocation, one is going to come up against position sizing. So whatever it is, 10%, 12%, whatever. As soon as it goes to 10.1, you need to take some off.
Yeah.
Because you're breaking your allocation.
Yep.
Right. So you already need to take some off. And then, right, okay. Then you can go back, if you can get a bit more quantity, and you can go and do a little back test and say, right, well, how often does it have a $50 day or a $50 week? Okay, well, it only happens once every 3 years, right? Okay, so I'm going to take more off because it doesn't happen very often. I don't have that one. That was just, but
yeah, you're just spitballing.
You can go as deep as you want. But at the same time, so if someone's at minimum, so this is where, if someone's at minimum and is adding on the way up, this is kind of so this is the first move. This is the move that came a few weeks ago in XLU. Okay. Which I don't think we're coming to now, potentially, is the reason why everyone thinks, oh, the first dip, I need to buy it, is because that's what did happen a few weeks ago. You had like 10 days ago, you had a chance. So everyone's like, oh, so as soon as it has a dip, I need to get in.
Yeah. Yeah. It's the recency bias. It's the recency.
So this is the kind of,
it's the nuance.
This is the psychology part of it.
Oh, big time. Yeah.
You could probably do, instead of looking by price, you can do it by time, I guess. You could do your back test by time if you want to do that, or there's probably a way to quantify it.
Yeah.
for me, that's a psychology thing. And so that's the big part. That was my first answer last night. It's like, this is definitely going to low end of range, and the low end of the range will be lower than you think it is now.
Correct. Yeah. I mean, yeah. I mean, this is you and I mentioned it yesterday. Like, I think gold is a perfect example of basically being like a month ahead of XLU, right? And you can see those two big red candles on the, what was it, the 13th and the 14th, right? Those are big drops, big moves. And again, I mean, if you're trying to catch it on I think that's the 14th, if you're trying to catch it on the 14th to the 15th, I mean, if you didn't have the patience to let it breathe and to sort of,
but I suppose that there was all kind of news, and that's, I don't know. You can overlay all kinds of news stuff. There'll be the overall stock market's down, or
correct,
rates have fallen. So people who couldn't allocate to TLT are now taking money that they had to allocate to XLU. They're taking it out of XLU and putting it into TLT now that they've got the chance. Who knows? There could be all sorts of things. Or
Chris, there's always there's always noise, right? And like I mean, I think I've certainly I barely listen to anything. I mean, not listen, but like in terms of just the noise, like it just, to me, it's just all narrative, and it doesn't matter, right? Because, to your point, some of the largest capital allocation if they factor it in, it's factored in with a million other different variables that they're making a decision based off of. And it has, for the most part, has nothing to do with a human making a decision. It is like a computer looking at the numbers and the charts and picking off, snippets of information from all sorts of different news articles globally. And, they're doing it at a much faster rate than I ever could. And therefore it's like, I have no edge there. I have an edge in terms of patience and making a decision and having a process that I can fine tune and improve and build upon every day, every week, right? Every month, and get better at it. And I think that's what this conversation is all about. And like, in terms of like what we're built, what this exploring the process is about, that's what the weekly notebook sessions are about. It's just about trying to get better, because this is, last week you mentioned it, and I think it's very much worth saying again. This is a challenging game, and we're playing with pros, and you can't just walk onto the pitch and try to bend it like Beckham, right? Or try to be Mbappe and have speed like a gazelle, and because that's just not who I am, right? I'm a 5'9", Irish Canadian. And that's just not my game, right? But I can try to outthink somebody, and I can try to outwork them, and that's kind of what we're trying to do. So with that, unfortunately, I got to go drop the kids off at school, so this session is going to be a little bit tighter today, but hopefully you enjoyed it. And obviously, if you've got any questions or want us to expand on anything, please leave a comment. I'm happy to do so. We love the engagement, so thanks again for everybody who's been tuning in, and we'll see you guys next week.
Cheers, guys.
Cheers.